You're listening to AI Prism from Seoul Economic Daily.
It's Friday, June 26th. Let's look at what this means for retail investors in Korea. And just to set our baseline for this deep dive, our mission today is really mapping market mechanics and risk. So to be completely clear up front, we are not making any buy or sell recommendations.
Right, we're just laying out the mechanics. And we should probably establish the exchange rate we're using, which is sitting near 1,541 to the US dollar.
Yeah. 1,540. And let's quickly define our benchmarks too. The KOSPI is basically Korea's equivalent to the S&P 500 for large cap stocks. And the KOSDQ is the tech heavy board, similar to the NASDAQ.
Exactly.
So looking at Thursday, the KOSPI had this just monster 5.4% jump up to 8,930. I mean, it rallied so hard it actually triggered a sidecar.
And the sidecar, just for background, is that automatic 5-minute trading halt that kicks in to cool down program-driven trading stampedes.
Right, it just pauses the chaos. But here's the thing I'm stuck on. If retail investors sold 2.42 trillion won, which is about $1.57 billion, and institutions bought 3.32 trillion won, or $2.16 billion, but wait, why on earth did retail trade against such a massive rally?
Well, the trigger for that whole institutional buying frenzy was Micron. They didn't just post over $41.46 billion in revenue. The real story is they locked in $100 billion, or about $154 trillion, 1 in 5-year supply contracts.
Which proves that AI demand is, translating into actual locked-in cash.
Yeah, it signals a true chip megacycle. I mean, this isn't a temporary spike. These companies now hold durable pricing power.
It's basically the difference between renting an Airbnb for the weekend and signing a strict 5-year corporate lease. You lock in that stability and it just re-rates everything.
Right, and we saw Samsung and SK Hynix surge because of that. If you look at FPER, the forward price to earnings ratio that investors use to gauge the cost of future earnings, Samsung is trading around 8 times.
And SK Hynix is at, what, 9.4 times?
Yeah, 9.4. So when you compare that to Micron trading at 19 times, the Korean chips look incredibly cheap to institutions.
Especially with those massive Q2 profit estimates on the horizon, like the projected $65 billion for Samsung and $45 billion for SK Hynix. But if the visible chip profits are so obvious, why is retail cashing out?
Because they're feeling the pressure from the exact same macroeconomic force driving all of this, which is high interest rates. And high rates create unseen systemic cracks.
Are you talking to the S&P warning, the one about Korean insurers holding $35 billion in high-risk overseas alternative investments?
Exactly. It's mostly commercial real estate, but it's obscured by layers of feeder funds, which are basically just funds that invest in other funds.
Okay, but if I'm a retail investor riding the tech wave, why do I care about an insurer's struggling office building in London? Does this blow back onto those corporate value-up governance reforms, the government push to boost shareholder returns?
It directly blows back. Because those real estate bets are hidden in feeder funds, the bad news takes months to trickle up. But when those bets sour, it heavily pressures the capital buffers and the dividends of the financial companies you might be holding.
Oh, I see. And that same interest rate pressure is also just hammering commodities, right?
Yeah, because a hawkish Fed keeps the US dollar strong, and that automatically makes dollar-priced commodities like gold, silver, and oil fall together globally.
Which explains why the one-listed precious metal ETFs dropped something like 10 to 12% this week. But speaking of ETFs, let's talk about the space theme ETFs, bleeding 287.9 billion won.
Which is roughly $187 million in outflows.
Right, $187 million just gone. But wait, isn't an ETF supposed to be safely diversified? How does a whole theme bleed like that?
It comes down to severe concentration risk. People thought they were buying a broad space theme, but the ETFs heavily weighted in SpaceX plunged roughly 25%.
While the one space ETF without SpaceX actually rose 4%.
Exactly. And this connects the entire through line for the week. The winners and losers were separated by concentration, understanding the underlying asset, and leverage.
And the leverage piece is a real powder keg right now. The margin loan balance, which is the money people borrow to buy stock on credit, just hit a record 38.6 trillion won.
Right, so roughly $25.1 billion in borrowed money. The danger there is forced liquidations.
Where brokers automatically sell off your holdings because your collateral drops too low.
Yes, and that's exactly what you need to watch going forward.
Right.
At early July, look at the Samsung and SK Hynix Q2 results to see if the chip megacycle actually holds weight.
Yeah.
Also keep an eye on the dollar index and track those margin debt levels.
Because if high rates are already hiding massive depreciations in real estate feeder funds and single stock vulnerabilities in thematic ETFs, you have to wonder what other safe corners of your portfolio are just highly leveraged bets in disguise. That's your retail investor briefing for Friday, June 26th. These episodes are produced with AI assistance and reviewed by a human editor, and nothing here is investment advice. We'll be back next week.
You've been listening to AI Prism from Seoul Economic Daily.